Good evening. Welcome to AS-10 Property, Plant and Equipment. How are you all people? Are you enjoying this standard? First, let me know that. Accordingly, today I will decide. Are you enjoying this AS-10 and are you enjoying the accounting standard lecture? We are taking in detail so that you can understand better. Objective is to understand when you will come to final stage. There is one similar standard called Ind AS 16 PPE, and that Ind AS 16 is very similar to our accounting standard 10. And that time you will remember me that yes, we had covered the same thing in intermediate also. So I am very happy most of you are enjoying this accounting standard. Our topic is right now exchange of asset. If assets are exchanged and there is a commercial substance, exchange of asset takes place and there is commercial substance in the transaction. Commercial substance in the transaction, then we have to see whose fair value is more clearly evident if fair values are available. If fair value of asset acquired and asset given both are available, but suppose the fair value of the asset acquired is more clearly evident, then the asset acquired will be recorded at fair value of the asset acquired, which in our example case 1 is 12 lakh. If suppose fair value of one asset is not available, but fair value of the asset given up is available, I will take that. If fair value of the asset given up is not available, fair value of asset acquired is available, I will take that. But if suppose fair value of both the asset cannot be measured, or transaction lacks commercial substance, or transaction lacks commercial substance, then I will value the asset acquired at carrying amount of the asset given up subject to any cash received or paid. Subject to cash received or cash paid. So that cash received or cash paid, if any, will be adjusted. Now we'll do some practice on this, right? So there is a question number example 1 just printed below. Example 1, if one fixed asset is exchanged for another fixed asset, say machine A is taken in exchange for motor car B. Oh my god, this is machine A and this is motor car B. Machine A is acquired, motor car is given, which has a book value of motor car is 1,50,000, means carrying amount. Carrying amount means book value. Book value means cost minus depreciation minus impairment loss. Okay, which has a book value of 1,50,000. Fair value of the car. Fair value means market value, the price at which knowledgeable and willing party will enter into a transaction. the fair value of the car is 1,70,000 and the fair value of machine acquired is 1,80,000. The question says, underline, the fair value of the machine is more clearly evident. The fair value of the machine is more clearly evident. So you have acquired a machine, you have given a car, so that machine will be recorded at what value? Will it be recorded at 1,80,000 or 1,50,000 or 1,70,000? At what value machine will be recorded? So the answer is fair value of that asset which is more clearly evident. So the question has said fair value of machine is more clearly evident. So that new machine A will be recorded at 1,80,000. What journal entry would the company pass? The company will debit machine A at 1,80,000. That was my query. Company will derecognize motor car. Company will remove motor car from the books at book value so that this motor car account gets closed. Motor car account gets closed. The difference between 180 and 150 is your profit. So that is called profit on exchange. Profit on exchange will be transferred to P&L account, 30,000 rupees. This is the journal entry for this question. Any query? If you have any query, kindly ask me now. Sanket, Ranjit, Sonam, you are right. Some students are participating, some are not participating. They are meditators. They are coming, meditating for 2 hours and will go away. If another example, example number 2. If a machine is taken by issuing 1000 shares of rupees 100 each, 1000 shares of 100 rupees each, the fair value of machine or fair value of security given, whichever is more clearly evident, that is reliable, known, will be considered. Say it is 1,50,000. Shares given, machine acquired. Shares acquired by a machine acquired by issue of shares. So what will be the journal entry? And the question says the fair value is 1,50,000. So tell me journal entry for this transaction. A company has issued its shares 1000 share of 100 rupees each, and in return it received one machine whose fair value is 1,50,000. What is the journal entry? So what I will do, I will record the machine at 1,50,000 and we have issued the share. So share capital issued 1000 into 100, but it is not telling. This time don't write P&L account. This time you will write securities premium, because this is on account of issue of own shares. This is on account of issue of own shares. Students sometimes ask the question, can we transfer it to P&L account? No, you cannot transfer to P&L account. Excess amount received on issue of own share is adjusted in securities premium account. So that was the answer. Now we'll solve one question number 11 printed in your book. Just turn 5 or 6 pages and you will find one question number 11. Question number 11. Have you reached question number 11? X Limited has a machine whose book value is 1 lakh. It intends to acquire a new machine. This is what happens in our day to day life also. We give away the old asset and we take a new asset. So, old machine book value is 1 lakh. It intends to acquire a new machine. So, now it wants to acquire a new machine. New machine in, old machine out. New machine in. This new model is priced at rupees 20 lakh. What is the fair value of this machine? New machine fair value is easy to find. 20 lakh. The vendor is willing to give credit of rupees 20,000 if the old machine is traded in. How is the new machine to be recorded? How is the new machine to be recorded? How is the new machine to be recorded? But what is the meaning of this line? The vendor is willing to give credit of rupees 20,000 if the old machine is traded in, and how the new machine will be recorded. So the meaning of this line is that this vendor says you can give me old machine and I will give it a value of rupees 20,000 only. But the cost of this new machine is 20 lakh. Old machine. Sometime you will also do the same thing. You give your asset. Suppose recently you purchased a mobile phone, okay, and you exchange your old mobile phone in the same shop. They will look at your mobile phone and they will say, we will give you 2,000 rupees for that. So the vendor says, I can accept your old machine only for 20,000. This is the value of the new machine. How much cash will be paid? My first question is, how much cash you have to pay extra? You took a new machine whose value is 20 lakh. You give an old machine, you gave an old machine, and the other party, the vendor says, we will take this old machine only for 20,000. Even if it is 1 lakh in your books of account, that is not material. We will take it as 20,000. So how much cash? How much cash you have to pay? Suppose this is Mr. Ranjit and this is vendor Usha. Vendor Usha. How much cash Ranjit will have to pay to Usha in this deal? So Ranjit is saying 19 lakh 80,000, Sanket is 19 lakh 80,000, Sonam is 19 lakh 80,000. How will Ranjit record this transaction? So journal entry in the books of Ranjit, the entity, it will record machine new debit at 20 lakh. 20 lakh. 2. Cash or bank 19 lakh 80,000. 2. Machine old book value. Book value you have to credit so that this asset gets derecognized, but it is not telling. There is a loss to this party Ranjit. So on the debit side, P&L account debit balancing figure. So this is 80,000 rupees loss to Ranjit. This entry please write down. This entry, if it is not written, write down. I think it is written alternative B. Only keep the alternative B in your notes and remove alternative A from your books. Only alternative B is the right answer because the fair value of the new machine is 20 lakh. So new machine will come in our books at rupees 20 lakh. New machine will come in our books at 20 lakh. This is the answer. Write a note here at the end of second answer, second alternative, first alternative delete. It is assumed that fair value of new machine can be reliably measured. Fair value of new machine can be reliably measured. It is assumed that fair value of the new machine can be reliably measured because it's a new machine. In case of new machine, you just go to the market, ask the showroom person what is the price of this machine and he can tell you. So if this is the assumption, this is the answer. Okay? And you will do some more practice yourself. Please, today, homework, solve all questions given to you, including those which were dictated to you. That will give you a holistic approach towards AS-10. Now next is other aspects of initial measurement. Kindly come to your notes. Kindly come to your notes. If the payment is deferred, if the payment is deferred, this you will find in para 15. Para 15 second line in point number A. If the payment is deferred beyond normal credit terms, the difference between the cash price equivalent and the total payment is recognized as interest expense over the period, and since it is interest expense, it is borrowing cost, and if it is borrowing cost, then one has to go to accounting standard 16. If accounting standard 16 permits capitalization, then you may capitalize this interest. If AS-16 does not permit capitalization, then you need not capitalize it. But now the student is asking, ki ultimately what is this concept? Suppose you purchased a machine on 1/4/2022, but you are going to pay on 31st March 24. After 2 years, you are going to make the payment. After 2 years, you are going to make the payment rupees 1,21,000. Normal credit period is 1 month or say 2 months. Which supplier will give you 2 years credit? If the supplier is giving you 2 years credit, that means this amount will include interest. A supplier will add his interest. He will think at the back of his mind that he is paying me after 2 years, my money is blocked, therefore I should charge him interest. So what you have to do, you have to find out what is the cash price of this machine. Cash price means if I exclude the interest, how much will I have to pay today? If I exclude the interest, how much will I have to pay today? If in the question cash price is given, well and good. Sometimes they may not give you cash price, but they may give you discount rate or interest rate. Suppose interest rate or discount rate is 10%. The question says interest rate is 10%. What is the cash price of this machine? How much amount one has to pay if he pays 100% down payment today? You say, I don't want credit. Tell me how much amount I have to pay. So you will have to pay 1,21,000 divided by 1 plus 0.10 to the power 2. So that is called cash price or present value. So type on your calculator 1,21,000 divide by 1.10, press equal to 2 times, and you will get the cash price, which is equal to, come on, which is equal to 1,21,000 divided by 1.10 equal to, the answer is 1 lakh. The answer is 1 lakh. Is it right? Saurav Chauhan is right, 1 lakh. So my accounting entry will move like this. We will record machine account debit 1 lakh to vendor account 1 lakh, and then I will provide for interest payable to vendor, because indirectly I am paying interest to vendor. Interest account debit, first year my interest will be 10% of 1 lakh, 10,000 to vendor account 10,000. Now my vendor account will become 1 lakh plus 10,000, 1 lakh 10,000. So in the second year, in the year 2, I will again pass an entry, interest account debit 11,000, 10% of 1 lakh 10,000, because 10,000 will get added cumulative to vendor account 11,000, and then year 2 I will pass one more entry, vendor account debit 1,21,000 to bank account. Tanya is right, 1,21,000. Chaurasia is right. What about others? Where have others gone? Gogoi is right. Jain is right. Waghmare is right. So this will be the entry. Here we have considered the financing cost. So I am going to dictate one question to you to help you to understand this concept better. So please write down one question. Write down. This question you will not find in your book. I have to take efforts to bring additional question which will clarify your concept. So please write down one question. On 1st April 20x1, on 1st April 20x1, an item of property, an item of property is offered for sale, an item of property is offered for sale at rupees 10 million, at rupees 10 million with payment terms, with payment terms being 3 equal installments, with payment terms being 3 equal installment of rupees 33,33,333 over a 2-year period. Over a 2-year period, payments are made on payments are made on 1st April 20x1, 31st March 20x2, and 31st March 20x3 and 31st March 20x3. The property developer the property developer is offering a 5% discount. The property developer is offering a 5% discount, that is rupees 5 million, if the payment is made in full at the time of completion of sale. If the payment is made in full at the time of completion of sale, implicit rate of interest is 5.36% per annum. Implicit rate of interest is 5.36% per annum. This they have calculated and given to you. This is the interest rate the vendor is charging. State how the property will be recorded in accordance with Ind AS 16. How the property will be recorded as per Ind AS 16. How the property will be recorded as per Ind AS 16. I will just read the question again for understanding. On 1st April 2001, an item of property is offered for sale at rupees 10 million, with payment being 3 equal installment. So this is 1st April 20x1, 31st March 20x2, and 31st March 20x3. You have to pay 33,33,000 in 3 installments, which comes to approximately 10 million or 1 crore. The total of this is 10 million or 1 crore. But you are given another choice. If you want to pay today, then you can pay 95 lakhs. This 95 lakh is cash price. Two choices you have. Choice number 1, you can pay in 3 installment. If you pay in 3 installment, you have to pay 33.33 lakh, which means you have to pay a total of 1 crore. 10 million is 1 crore. If you are going to pay 100% amount today only, down payment, the supplier will offer you a discount of 5%. 5% means, you write down here, I think there is some calculation error. It should be 0.5 million. 10 million into 5% is 0.5 million, which is 5 lakh. Pay 95 lakh today, full amount, or you pay 33.33 lakh over 3 years. So what this company has decided? It has decided to pay in 3 installment, which means the total interest included is 5 million. the total interest included is 0.5 million or 5 lakhs or 5 lakhs. The total interest included is 5 lakh. So how are you going to do the accounting of this? So understand, you are going to pay 100 total, 5 is interest you are paying for delayed payment. So the cash price of this machine is 95 lakh. So I will record the machine at 95 lakh and I will provide for interest on outstanding balance. I will provide for interest on outstanding balance at the rate of 5.36%. So let us see how to do the accounting. Machine will be capitalized at 95 lakhs only. 5 lakh is interest and that will be recognized over 2-year period at the rate of 5.36% on the opening balance. Please write the answer. The important thing is how will you present the answer. So you will write AS-10 requires AS-10 requires AS-10 requires that the cost of an item of PPE, the cost of an item of PPE is the cash price equivalent, is the cash price equivalent at the recognition date, is the cash price equivalent at the recognition date, is the cash price equivalent at the recognition date. Now write down journal entries. Journal entries. Draw the format date, particulars, debit, credit. Date, particulars, debit, credit. This question is very similar to the questions of installment system. Okay. So 1st April 20x1, date column write down. In the date column write down 1st April 20x1. We are going to record the asset at cash price, which is 95 lakh. So student will write PPE account debit 1 crore minus 5%. 5% is your cash discount, which is nothing but your interest over 2-year period. Cash price is 95 lakh. PPE account debit 95 lakh. Cash price means if you pay 100% down payment, how much will you pay? To cash and bank account, question says the first installment was paid today itself. The first installment was paid today itself, that is 33 lakh 33,333. Cash or bank you can write. The remaining amount will be paid over 2 installment. So write down 2 accounts payable. 2 accounts payable 61, 66, 667 being recognition of property. Journal entry narration being recognition of property. Now what I'll do, in the date column I will write 31st March 20x2. 31st March 20x2. On this opening outstanding amount, you will have to calculate interest at the rate of 5.36%. So please, dear student, tell me what will be the interest on 61, 66, 667 at the rate of 5.36%. Take your calculator and try. So I will have to record the interest on opening balance at the rate of 5.36%. So interest expense account debit, anyone, interest expense account debit 5.36% of 61,66,667 that is 3,30,533, and we have to pay an installment of 33,33,333. Out of this, 330,533 is the interest component. So balance amount is the principal component. Balance amount is the principal component. So this is your balancing figure. This is your balancing figure. Out of total 33 lakh 33,333, 3 lakh 30,533 is your interest portion. Therefore, 30 lakh 2,800 is the principal portion of the loan paid. The narration write down: recognition of interest expense, recognition of interest expense and payment of second installment, and payment of second installment, recognition of interest expense and payment of second installment. Now in the date column write down 31st March 20x3, 31st March 20x3, 31st March 20x3. So take on your calculator, this was your accounts payable, 30 lakh 2,800 you have paid. So what is the balance left in accounts payable? What is the balance left in accounts payable account? What is the balance left in accounts payable account? Take the difference and give me the answer. Balance left in accounts payable account 61, 66, 667 and minus 30,02,800. So the amount left in your accounts payable account is 31 lakh 63,867. Very good, Ranjit. And you have to pay 33 lakh 33,333, which means the difference that you are going to pay in the last installment is towards interest. So the interest you are going to pay is total amount you have to pay is this. To close the accounts payable, we have to debit this amount. So what I'll do this time, interest I will debit 169,466. So that will close my account. That will close my account. So you will write interest expense. Either you write 169,466 or 467, doesn't matter. That is balancing figure. Accounts payable debit 31,63,867. Somebody in future will ask me, sir, how did you get this number? So it is better to write the calculation for that. And then to bank 33, 33, 333. Or if you want to write 4, it's okay. Then adjust 1 rupee here and write a narration. Recognition of interest expense and payment of final installment. Such questions are asked for something around 4 to 5 marks. If you practice well in advance, you can solve it very easily. Okay? Usha is right. Sakshi is right. Chaurasia is right. This answer is over. Any query? Any query? Ask me. This is a question where the amount is paid in installment. How will you record the asset? How will you record the liabilities? How will you record the expense? And what will happen to this interest? It will be transferred to P&L account. Write down in bracket P&L account, P&L account. And what will you do with this PPE? This PPE will be depreciated. But we don't have information about either the depreciation rate or the useful life. 3 year is not the useful life. 3 year is the installment period, or 2 year is the installment period. So PPE will be depreciated, information not available. Interest expense will be transferred to P&L account. So now we'll go to next concept. Consolidated price is paid for several items of PPE. So suppose you purchased land and you purchased building, and you just paid 1 crore rupees. Is it 1 crore? No. You paid 1 crore rupees for land and building. The question is, in our books of account, I can't write land and building. I will have to write like this: land account debit, building account debit, to bank 1 crore. Now the problem is, when I paid 1 crore for both. The standard says you have to bifurcate this 1 crore. In what ratio? In the ratio of their respective fair value. In the ratio of their respective fair value. So suppose the fair value of land is, let us say, 25 lakhs, and the fair value of only building is, say, 80 lakhs. Together 105 lakh, but because I paid one lump sum amount, I could purchase both for 1 crore. Now the question will be, I will have to divide this 1 crore in the ratio of 25 is to 80. I will have to divide this 1 crore in the ratio of 25 is to 80, which is their standalone fair value. So student will take on calculator 25 divided by 105 into 1 crore. So that is equal to, land will be debited 2380952 and building will be debited balancing figure. Building will be balancing figure. 1 crore, then minus 2380952. So for the purpose of accounting, I will take these figures. You are right. Sakshi is right. Chaurasia right. Moonrise Chaurasia, very good. Sometimes what happens, we purchase a building. Now it may have land also. It may have furniture also. It may have electrical items also. Okay. So in that case, AC. In that case, I will have to apportion in the ratio of fair value of land, building, furniture, air conditioner, electrical equipment. So if one amount is paid, two or more assets are acquired, allocation will be based on respective fair values. Okay. When fair values cannot be measured reliably, these values are estimated on a fair basis as determined by a competent valuer. Then your question will be, what if I cannot calculate fair value? Go to a valuer, and then the valuer will tell you separately what is the fair value of each item. Now we'll come to example number 3. If you see, there is one example number 3 for clarification of your concept. P Limited purchased a factory including land building at a cost of 8,60,000. Factory building, but also it got land in along with that. The separate valuation of land is 2,50,000 and building is 5,30,000 respectively. How the land and building will be shown in the balance sheet? So 8,60,000 is consolidated price. I will apportion it over two assets, land, building. And what is the ratio I will use? 250 is to 530. So you will have to take 250 divided by 780 here and 530 divided by 780 here. So dear student, please apportion in the ratio of 250 is to 530. How much will you apportion towards land? 250 upon 780 into 8,60,000. Come on, 250 upon 780 into 8,60,000. So the answer is, for towards land we will apportion 275,641. 275,641, and the amount you will apportion towards building is 584,359. This way you will do the calculation. So when one amount is paid, two or more assets are acquired, the amount will be apportioned over two or more asset in the ratio of fair value. So Sakshi, Usha, Moonrise, Chaurasia, you are right. Next paragraph number 4. Cost of an item of PP held by a lessee under a finance lease. Now this is simple. If you have acquired a PPE item under a finance lease, you will apply the principle of AS-19. AS-19 says it will be recorded at the lower of fair value and present value of minimum lease payment. This will be covered in AS-19. So I will request the student not to ask me the question on what is the meaning of fair value, present value of minimum lease payment. It is the present value of your rentals. But it has got some more discussion pending that will be covered in AS-19, not today. You will just write in the exam, PP acquired on lease under a finance lease is covered by AS-19. Similarly, if you have acquired asset under government grant, AS-12 will apply. AS-12 will apply. For example, suppose Sachin Tendulkar got a land. He wants to use this land for promoting sports. So Maharashtra government gave him land for promoting sports. So there are two possibilities. One is he got it free of cost. Second, he paid a nominal amount. Nominal amount. Nominal amount means the market value is 5 crore. Actual amount paid by Sachin Tendulkar is 10 lakh only. That is called nominal amount, much lower compared to market value. So what we will do, we will apply AS-12. AS-12 is called Accounting for Government Grant, coming soon. Accounting for Government Grant. So if it is free of cost, then recognize at nominal amount. For example, Tendulkar will pass the entry. Since it is free of cost, you will just record it 1 rupee or 10 rupees or 100 rupees to P&L account. But if you have paid some amount, then you will record at that amount only which you have paid. In case if you have paid some amount for that, then you will record it at that amount. More about asset acquired in the form of government grant. More about that we are going to cover in our AS-12. Okay. If it is free of cost, then just record it at 1 rupee, 2 rupees, 5 rupees. And if it is at an amount paid, some nominal amount is paid, then on the basis of actual amount paid. Don't worry about this because this is going to be covered again in detail in AS-12. What we have discussed till now, asset to be recognized at the beginning. So we have taken following cases. For your understanding what we have covered, let me just tell you, if asset is purchased by paying cash or bank, asset is purchased by exchange of another asset we have covered, asset is purchased in a deferred payment basis, installment basis, delayed payment basis. Then we have discussed more than one asset purchased by way of a consolidated price, asset acquired under lease, asset acquired under government grant. How these assets will be initially recorded, that we have done. That means the date we purchased the asset, this is the amount at which the asset was recorded. Now the next task is measurement after recognition. So I have purchased the asset on 1/4/22. On 31st March 23, how will I record it? On 31st March 23, how will I record it? So now the standard says you have two choices. Paragraph 16. You have two choices. Either you can follow cost model or you can follow revaluation model. Either you can follow cost model or you can follow revaluation model. AS-10 gives you two choices. AS-10 gives you two choices. Either you can follow cost model or revaluation model. What is cost model? See this diagram below. See this diagram below. What is cost model? Cost model means the amount will be cost that we have discussed for last 1.5 hour and previous lecture also. We have discussed cost. So take the cost that we have initially recorded minus any accumulated depreciation. Accumulated means total depreciation till date. Total depreciation till date and minus any accumulated impairment loss. Impairment loss is given in AS-28, not in syllabus. Very good. Enjoy. Impairment loss means decline in value of the asset. that is called impairment. But you don't worry about it, it is not going to be asked in group 1 as this is not there. This is called cost model. What you have learnt in your life in 11th or 12th or in foundation course, it was cost model only. First you capitalize the asset and then just depreciate it every year. Okay. But AS-10 gives you second choice also. So you have to decide what you want to do. You want to follow cost model or revaluation model. If you want to follow revaluation model, it means the asset will be carried at revalued amount. The reason for allowing this is that suppose for example you have building in your books. Building was purchased in 1990 for 2 lakh rupees. Building was purchased for 2 lakh 1990. In 2022, the same building value is 25 lakh rupees. If I follow cost model, the building will appear in my books at 2 lakhs minus depreciation, whatever is that. Now let us say after depreciation it comes to 1 lakh only, whereas the market value is 25 lakh. Whereas the market value is 25 lakh. Okay. So my balance sheet is showing building under cost model as 1 lakh, whereas its market value is 25 lakh. So my balance sheet is not showing a fair view, true and fair view of financial position. My balance sheet is showing a building at 1 lakh, which is actually having a market value of 25 lakh. So the standard says you can follow revaluation model so that you can revalue upward. It can be downward also. You can revalue upward the value of building and bring it near to its market value. And bring it near to its market value, and that is why revaluation model is also allowed. So what I will do in revaluation model, I will revalue the asset which will be the fair value at the date of revaluation. So I will take fair value on the date of revaluation minus any subsequent accumulated depreciation and minus any subsequent impairment loss. So one important point to be noted is revalued asset is also depreciated. Revalued asset is also depreciated. Who says revalued asset is not depreciated? So suppose I have done the revaluation on 1/4/2022. I will depreciate for 2022-23. What is the harm? And if I find that the value has changed, I can again do the revaluation. But if I find that the value has not changed, I can continue to depreciate as long as there is no need to revalue. Is this right? Up to this any query? Up to this any query? Today you note down one homework. There is one example 4 printed in your book under para 16. So please complete it as homework. You can check the answer. Now next is cost model. Students are requested to be present every day to understand what is happening in the classroom. Cost model, you will find all these points are printed in your book. So don't write. Cost model implies that the item of property, plant and equipment is not revalued during its useful life. So let us say I bought this pen for 200 rupees. So initially I will recognize it at 200, and then suppose its life is 5 years. So every year I am going to depreciate. Every year I am going to depreciate 40, 40, 40, and this way you will be able to write off this value of this asset. Okay. So now this is called cost model. Cost model is very easy. And the alternative model is revaluation model. Alternative model is revaluation model. Institute will test you on revaluation model, because in cost model there is no action, no drama, no thrill, no suspense. The action, drama, thrill, suspense lies in revaluation model. Revaluation can be both up, down. So value of the asset may be 1 lakh, it may be revalued to 20 lakh. Value of the asset may be 20 lakh, it may be revalued down to 15 lakh. AS-10 permits both type of revaluation, upward as well as downward. Logic, I have told you, the logic is to bring it closer to the market value. The logic is to bring it closer to the market value. Okay. So revaluation model envisages that the carrying amount of the asset is adjusted for its fair value on the reporting date. So the idea is book value should be close to its fair value. What we see in the balance sheet date, on the balance sheet, what we see on the balance sheet should be close to its fair value. That means if somebody wants to know what is the value of this building, you can look at the balance sheet and you will get a rough idea. Now, how do you calculate fair value? Now, this is not important for us. This will be provided to you in the question. This will be provided to you. However, the student are interested in knowing. For such inquisitive minds, such learned minds, income approach can be used, depreciated replacement cost approach can be used. As I said, not very important, because we are not going to take a question on this. Income approach means discount the future cash flow, estimate how much cash flow asset will generate, estimate cash flow asset will generate, and then take present value of this estimated cash flow. This is called discounted cash flow approach. And the second one is called depreciated replacement cost approach. That means if I purchase the similar asset today, if I purchase the similar asset today, if I purchase the same machine today, if I construct the same building today, how much will it cost me? How much will it cost me? That is called current cost approach or depreciated replacement cost approach. So let us say this calculator I purchased 5 years ago. What will be its fair value today? How much amount I will pay to buy the similar calculator with same service potential? So that is called depreciated replacement approach. Now we'll come to some important points about revaluation. So in your book, paragraph number A, B, C, D, E, F, A to F, pay attention. I have written everything in simplified format. So paragraph number A in your book deals with frequency of revaluation. Deals with frequency of revaluation. How frequently you should revalue your asset if you are following revaluation model, so they have given a very general statement. Revaluation should be done with sufficient regularity. Revaluation should be done with sufficient regularity. Oh, that means you should do it regularly. Maybe once a year, maybe once in 2 years, once in 3 years. Whatever frequency you will choose, whatever frequency of revaluation you will choose, ensure that your book value and your fair value does not differ much. So there is no major gap between the book value and the fair value on the balance sheet date. So for understanding purpose, I have just simplified your notes. If suppose the fair value changes more frequently, if fair value of PP changes more frequently, fair value is very volatile, then it is better to do annual revaluation. Then it will be better to do annual revaluation. But if the fair value does not change frequently, if the fair value of the PP does not change frequently, is not very volatile, then the company can choose the policy of revaluing it over 3 to 5 years. So that means you can just revalue once in 3 years if the fair value is not very volatile. But if you find that fair value is volatile, then in that case you can revalue every year. Let us say, for example, building. Building's fair value is changing very fast. So here I can use annual revaluation, but machinery fair value may not be changing very fast. So there I can use 3 to 5 years. That is for a theory question. Now important point, when PPE item is revalued, the entire class of item of PP should be revalued. When you want to revalue PPE, the entire class of PP should be revalued. Now this is one condition given by this standard AS-10. So what do you mean by entire class of PPE? Entire class of PPE means land is one class, building is one class of asset, machinery is one class, ship, aircraft, motor vehicle, furniture, fixture, office equipment, bearer, plant. These are classes of PPE. If you want to revalue, suppose machinery, you have 3 machines with you, then you have to apply revaluation model to all the 3 machines. Selective revaluation is not permitted. Selective revaluation is not permitted. Any query? Now your query can be, can I follow cost model for building and can I follow revaluation model for machinery? Then the answer is yes. You can follow one model for one class of asset, you can follow another model for another class of asset. That is acceptable. So please ask me any query you have. Okay. Please see whether you have a query. Just a second. देखो तो क्या हो गया. हैंग हो गया इधर. Okay, any query from you? If you don't have query, now understand the accounting treatment. So first point you have understood, entire class should be revalued. Entire class of PPE should be revalued. Entire class of PP should be revalued. Second thing, what about the accounting treatment? What about the accounting treatment? All these points are given in your book in under the heading point number B. Accounting treatment is whenever the PPE will be revalued, it will be credited to, if it is upward revaluation, an account called revaluation surplus. So normally we write like this in the classroom, PPE account debit to revaluation reserve, or you can say revaluation surplus, no problem. And this will directly go to reserve and surplus, which means if you are revaluing the PPE for the first time upward, the gain on revaluation you will not take it to P&L account. It is not realized profit. It is unrealized profit. It is just a book entry. So our standard setters have said, don't take it to P&L account. This profit is arising because you have just revalued your asset. It is an unrealized profit. So you have to take it to a reserve called revaluation reserve, not to P&L account, so that your profit and loss account is not affected. But yes, in your balance sheet, reserve and surplus will increase. Asset side, asset value will go up. Liability side, reserve and surplus will go up. However, if you revalue an asset downward for the first time, suppose, then it is a loss. Here I am going to charge the loss to P&L account. At the time of recording the decrease in value, we can debit P&L account. This is a loss we are transferring to P&L account. This is my loss, my value of the asset has gone down. So conservative approach, we are transferring it to P&L account. But when it goes up, I don't credit P&L account, rather I credit revaluation reserve. So this is the entry you have to pass for upward and downward revaluation. For upward revaluation, credit revaluation reserve, but for downward revaluation, debit P&L account. However, paragraph D now in your book, however, increase should be recognized in P&L account to the extent it reverses the revaluation decrease already recognized. Oh my God. Suppose in year 1, there was a downward revaluation. There was a downward revaluation of rupees 100. So I will pass the entry in year 1 P&L account debit 100, P&L account debit 100 to PPE 100. But then what happened in year 2? I need to revalue upward by 200. I need to revalue upward by rupees 200. So the standard says, if earlier you have debited P&L account, then second time, in case if you have to revalue upward, then you will first credit P&L account to the extent you have debited earlier. So this 100 I will give back to P&L account. Last year I have charged, now I will credit, and the remaining amount, if any, I will transfer to revaluation reserve. Remaining amount, if any, I will transfer to revaluation reserve. This is how the accounting is done for an asset which was earlier revalued downward but later on revalued upward. Is it right now? Let us come to another situation. Similarly, decrease should be debited to revaluation surplus to the extent of existing credit balance in respect of this asset. Now see the situation number 2. In year 1, there was an upward revaluation of 100 rupees. So I will pass the entry PPE account debit 100 to revaluation reserve 100. But then what happened in year 2? I have to do a downward revaluation. I have to do a downward revaluation by 200 rupees. Oh, so here I will first debit revaluation reserve 100 rupees because that is the balance with me. Then I will debit P&L account 100 and to PPE 200. So if you have revalued upward in year 1 and then the same asset is needs to be revalued downward, first use balance in revaluation reserve, and if that is not sufficient, then you debit the balance to P&L account. Is it right? Any query on this? So what we will do in our notebook, draw this chart. Draw this chart quickly. This will help us to understand the treatment should be given for revaluation. It might take some time, but I am sure it will be very useful to you. So you follow my instruction and start writing. Take out a full page notebook and on a fresh page write down revaluation of asset. Then left side write down first time revalued. First time revalued. If you are revaluing first time, check whether there is increase in value. Check whether there is increase in value. If the answer is yes, credit revaluation reserve. Credit revaluation reserve. If the answer is decrease in value, if the answer is decrease in value, the answer is decrease in value, then you say charge to P&L account. Then you say charge to P&L account. Everybody is writing. Say yes. Please tell me, are you writing? Say yes or no. Louder yes. Everybody. Yes. So we will now go to this point. Previously revalued. If an asset is previously revalued, then next year or subsequently check whether there is decrease or increase in value. There are four possibilities. There are four possibilities. Consider four possibilities. Yes, most of the students are writing. Draw one arrow below, and now we have four possibilities. 1, 2, 3, 4. According to what happened earlier and what you want to do now will give the treatment. Usha, write down. Suppose we have present increase, now we want to increase. Last year also we had increased. Increase means last year also we have credited revaluation reserve. This year also we will credit revaluation reserve. This is my situation 1. Second possibility, present decrease plus previous increase. Oh, present decrease but previous increase. So what I will do, this decrease charge to revaluation reserve. Charge to revaluation reserve. How much? To the extent of previous increase, or you can say to the extent of balance in revaluation reserve, and charge the remainder, if any, to P&L account, and charge the remainder, if any, to P&L account. So first I will utilize revaluation reserve. If that is not enough, then we will charge P&L account. Next one, this is third possibility. Present increase, this year increase, but previous year it was decrease. Current year increase in value, previous year decrease in value. So previously we had charged to P&L account, so we will credit the P&L account to the extent of previous decrease. So you are going to credit first P&L account to the extent of previous decrease and credit the remainder, if any, to revaluation reserve, and credit the remainder, if any, to revaluation reserve. So first you credit P&L account to the extent we had debited last time, and remaining amount credit to revaluation reserve. Fourth possibility is decrease now, decrease earlier also. Current year decrease, previous year also decrease. Decrease. If it is decrease, last time also we charged to P&L account. This time also we will charge to P&L account. Last time also we charged to P&L account, and this time also we will charge to P&L account because this time also there is a decrease. So complete the chart, and once you have completed, tell me. Note down everybody nicely. So this gives you a very good idea about treatment of revaluation upward and downward, first time as well as subsequent time. So Thanga Lakshmi Surya has completed. What about other student? Have you completed? Yes, please tell me. Have you completed? Have you completed? All of you? Yes. So now we'll come to next point, number E in your book. Point number E, as the asset is used by the enterprise, a portion of the revaluation surplus may be transferred to revenue reserve. So the standard says if you have revalued an asset upward, suppose an asset was last year 1 lakh, we have revalued it to 1,50,000. This was balance 1 lakh before revaluation. This is balance after revaluation. Suppose the depreciation rate is 10%. So I will now provide depreciation on revalued amount. Once an asset is revalued, subsequently depreciation is charged on revalued amount. Let us say depreciation rate is 10%. So I will provide 15,000 depreciation. But if I would not have revalued the asset, I would have provided depreciation on original value and it would have been 10,000. Due to revaluation, I have to provide excess depreciation of 5,000 rupees. Because of upward revaluation in my example, I had to provide additional depreciation of 5,000 rupees. Okay. Now the standard says, in case if you provide additional depreciation due to revaluation, a portion of revaluation surplus may be transferred to revenue reserve. So the journal entry would be revaluation reserve account debit 5,000 to general reserve. Revenue reserve means general reserve 5,000. So what the company will do, this excess depreciation provided because of revaluation will be released from revenue reserve to general reserve. Will be released from revenue reserve to general reserve, because now the value of the asset has gone up, you will charge more depreciation. But at the same time, the standard gives you a right that because you have provided excess depreciation, we allow you to transfer that additional depreciation to a free reserve called revenue reserve. So that entry can be done. Excess depreciation arising due to revaluation can be transferred from revaluation reserve to general reserve. Now we'll come to point number F in your notes. Point number F in your notes. Suppose an asset is sold. This asset was revalued upward earlier. This asset will be derecognized from the books, that all of you will agree. When the asset is derecognized, any balance lying in revaluation reserve, any balance lying in revaluation reserve will be transferred to general reserve. Any balance will be transferred to general reserve. So once the asset does not exist, once the asset is derecognized, the related revaluation reserve is also not kept in the books, it is transferred to revenue reserve, which means while writing the entry general reserve. So the entry would be once the asset is derecognized, the related balance in revenue reserve will be transferred to general reserve. So derecognition means asset is eliminated from the books of account. Corresponding revaluation reserve is also transferred to revenue reserve. Okay. Now there is an important note in the last line. It says all transfer from revaluation reserve will be made to revenue reserve and not routed through statement of P&L account. So we are not going to transfer revaluation reserve to P&L account. Revaluation reserve debit to P&L account is not allowed. You can't increase your profit balance by transferring revaluation reserve. The standard says you can't increase your profit and loss account balance by transferring the revaluation reserve. However, excess depreciation or balance in revaluation reserve on derecognition, those can be transferred to revenue reserve, that is general reserve. Come to point number B. Point number B, write down important, and I am going to give you a question also on this. So that is why I am taking it later. First I finish the theory part, and now I am going to discuss the actual accounting treatment that is done. Where an item of PPE is revalued, the adjustments are made in the following ways. Previously I just said PPE account debit to revaluation reserve. But in the question you will be given, cost less accumulated depreciation, net carrying amount, and then you will be given revaluation amount. Now the question is, how are you going to pass the journal entry when you are also given accumulated depreciation in the question? If only the net amount was given, then I will pass PP to revaluation reserve. But if accumulated depreciation is also given, then what I'll do? The standard allows us two methods of accounting. Standard permits me two methods. This note is printed in your book also in point number B. You don't need to write. One method is the gross carrying amount is adjusted in a manner consistent with the revaluation of the carrying amount of the asset. That is, the gross carrying amount may be restated by reference to observable market data, or it may be restated proportionately to the change in the carrying amount. Tick mark this line. What this first method says, you increase the gross carrying amount, you increase the accumulated depreciation proportionately. So if your carrying amount increases by 50%, you increase the gross carrying amount and depreciation also by 50%. So I am going to show this with the help of one example. So write down one example in the notebook, because unless you see the number, you will not be able to interpret that paragraph. First method is where we proportionately increase the carrying amount of fixed asset as well as accumulated depreciation. So student will write cost of an asset equal to 1000, cost of the asset 1000. Please write in the notebook, cost of the asset 1000, accumulated depreciation 400. See, if cost is 1000, accumulated depreciation is 400, so net carrying amount is 600. Now this asset is revalued to 1200 rupees. Now this asset is revalued to 1200 rupees. And you have to increase the gross carrying amount and you have to increase the accumulated depreciation. This is first method. Okay. So what I will do, I will check my net carrying amount is 600 rupees, revalued amount is 120, So what is the percentage increase? 1200 minus 600 divided by 600. So you will say the percentage increase is 100%. The percentage increase is 100%. So what I'll do, I will take 100% of this. I will increase this by 100%, 1000 rupees. I will increase this also by 100%, 400 rupees. So now I will pass an entry where I will increase the gross value by 1000. I will also increase accumulated depreciation by 400. So automatically what will happen? My net increase will be 600 rupees. My net increase will be 600 rupees. So write down the entry method 1. Method 1 entry will be PPE account debit to accumulated depreciation to revaluation reserve 600. This 600 is 1200 minus 600. How much amount you will put here and how much amount you will put here? That is the question. How much amount you will put in front of PPE and how much amount you will put in front of accumulated depreciation? So you will say 1000 rupees in front of PPE. Why 1000? 100% of 1000. Why 400? 100% of 400. So automatically your entry would tally. This is how the student will pass the entry if you are given accumulated depreciation figure in the question. Okay? Have you noted it down? Very easy. And I will take one more question for practice, don't worry. Now there is something called method 2 also printed in your book. Point number B. In method 2 what I will do? I will close the accumulated depreciation account against the gross carrying amount of the asset. So what they are trying to say, first you close accumulated depreciation account, accumulated depreciation account debit to PP. Whatever is your book value of accumulated depreciation, if you reverse it, that account will close. After passing this entry, this is my step number 1. After passing this entry, I will compare revised carrying amount of PP with revalued amount. I will compare the revised carrying amount of PP after passing the first entry with the revalued amount, and then I will pass the step number 3. Entry would be PPE account debit to revaluation reserve. So I will compare these two figures, calculate the difference and pass entry for the difference. So exactly how to apply this method, let us see with the example. Same example I will take. Okay. So write down example in the notebook, or you can just say solve the above question by method 2. Solve the above example by method 2. Solve the above example by method 2. Solve the above example by method 2. So all of you try. So what I'll do, first step we will eliminate the accumulated depreciation. Accumulated depreciation account debit to PPE account. Accumulated depreciation account debit to PPE account. 400. Now you see the effect of this entry. If you pass this entry, what will happen? This will reduce by 400. This will also reduce by 400. So after the first entry, the balance in revised carrying amount of PPE is 600 rupees now after this entry, and the balance in accumulated depreciation has become 0. Compare this 600 rupees with this 1200 rupees. Now my carrying amount is 600 rupees and my fair value is 1200 rupees. So I will have to increase it by 600. I have to increase it by 600. So I will pass one more entry. PPE account debit 600, 1200, this 1200 given here, and this 600 is that revised value. 2. Revaluation reserve. 2. Revaluation reserve 600. So after passing all these entries, how will my balance appear? This cost will appear at 1200, depreciation will appear as 0, and my book value after all this entry will become 1200 rupees. So student will have to be careful. If accumulated depreciation is also given, either follow method 1 where we will proportionately increase the gross amount and the accumulated depreciation, or you can follow method 2 where you first eliminate the accumulated depreciation and then pass the entry for revaluation reserve. So what I will do, to make your concept clear by both the method, we will write an actual question. So please write down question. Good student will write all questions which are dictated. This will really help you to understand your concept better. Chapter is lengthy, and if you want to understand, we have to solve numerical examples also. So student will write a small question which can be for 4 marks in the exam. In the notebook write down, Vino Limited purchased plant. Vino Limited purchased a plant. Vino Limited purchased a plant at a cost of rupees 10 lakh. At a cost of rupees 10 lakh on 1/4/19. On 1/4/19. Life is 10 years. Life is 10 years. On 1/10/2020. On 1st October 2020. 1st October underline. Vino Limited revalued the plant. Vino Limited revalued the plant. Now this is after 1.5 years. Vino Limited revalued the plant. Fair value is rupees 9,35,000. Fair value is rupees 9,35,000. Pass journal entries under both methods. Pass journal entries under both methods. Pass journal entry under both methods. So first understand, the asset was purchased on 1/4/19. There will be a year ending date 31st March 20 and then 1/10/2020. First we will depreciate the asset for 1 year here, then we'll depreciate the asset for 6 months here. You will get the carrying amount of PPE. First depreciate here, then depreciate for 6 months. Life is given 10 year. Compare with the fair value. Is it right? And then we will pass the entries. So let us write down Journal of Vino Limited. Journal of Vino Limited. Please write down very important question. Journal of Vino Limited. Draw the journal entry format. Draw the journal entry format. First, we will pass entry on the date of purchase. 1/4/19, plant account debit 10 lakh to bank account 10 lakh. Everybody agrees? Plant account debit 10 lakh to bank account 10 lakh. Being plant purchased. Being plant purchased. Then 31st March 2020, this is the first year, life is 10 year, scrap value 0, so depreciation would be 1/10 of 10 lakh. 10 lakh divided by 10, 1 lakh. To accumulated depreciation, 1 lakh. Being depreciation charged. Being depreciation charged. And you will show the calculation. Never forget to mention the calculation in the answer. 10 lakh divided by 10 years. This is year 1. Draw one line. Year 1 activity is over. But then we have to revalue the asset on 1st October. So I will need to provide a depreciation for 6 months now, so that I will get the carrying amount on the date of revaluation. So now my depreciation will be half of it. If 1 lakh is for full year, 50,000 is for half year, being depreciation charge for 6 months. 1 lakh divided by 2. Calculation of this 50,000. 1 lakh divided by 2, 50,000. These are the entries you will pass before revaluation. Now just understand, your plant account balance will be 10 lakh gross and accumulated depreciation will be 1 lakh this one and plus 50,000 this one. So accumulated depreciation is 1,50,000. Right now the carrying amount is 8,50,000. Right now the carrying amount is 8,50,000 and the question has given you revalued amount or fair value as how much was that? 9,35,000. These are the data that I need right now. I need gross amount 10 lakh. I need accumulated depreciation. I need accumulated depreciation 1,50,000. I need accumulated depreciation 1,50,000 and I need carrying amount 8,50,000 and then revaluation amount. Revaluation amount is 9,35,000. The revaluation amount is 9,35,000. क्या हो गया? हाँ नहीं हो। हम्म हम्म Okay, so this is 9,35,000. These are the data that I need. So now we need to pass the entry on 1/10/2020, revaluation under method 1. Revaluation under method 1, depreciation elimination approach. Depreciation elimination approach, write down. Depreciation elimination approach means this 1,50,000 depreciation which is lying in the books, I will reverse. I will debit that accumulated depreciation account. So that accumulated depreciation account balance will become zero. So you will say accumulated depreciation account debit 1,50,000 to PPE 1,50,000 to PP 1,50,000 being accumulated depreciation eliminated. Being accumulated depreciation eliminated. After passing this entry, this PPE balance, which was 10 lakh, will become 8,50,000. Compare 8,50,000 with 9,35,000. So, what is the increase in the value for which I have to pass the entry now? Come on, student will answer. I will have to revalue the asset from 8,50,000 to 9,35,000. So increase it by how much amount? Your 8,50,000 needs to be revalued to 9,35,000. So the entry will be PPE account debit 9,35,000 minus 8,50,000 debit 85,000 to revaluation reserve. To revaluation reserve, that is 85,000. Tanya, Thanga Lakshmi, Sonam, Sanket Jain, Sakshi, Ranjit, you people are right. Okay. So this completes method 1. Now right below, revaluation method 2, restatement approach. Revaluation method 2, restatement approach. Restatement approach means I will have to check, see on the screen, my net value is 8,50,000 and revalued amount is 9,35,000. So increase in value by 85,000. So the percentage increase is 85,000 divided by 8,50,000 and that is 10%. So under this restatement approach, what I will do? I will increase the plant account by 10%, which will be 1 lakh rupees. I will increase the accumulated depreciation account by 10% of 1,50,000, which is 15,000. So therefore, if I am following restatement approach, plant account will be debited by 1 lakh. Accumulated depreciation will be credited by 15,000. Remaining amount I am going to credit to revaluation reserve. So write down below the calculation of that 10%. Later on, you will not have confusion. So everybody take out your notebook, continue in the same place, revaluation adjustment, or you can make a working note, keep 5 lines blank and write working note 1. After keeping 5 lines blank, you write working note 1, revaluation adjustment. My book value, on 1st October 2020 is 8,50,000. My fair value on 1st October 2020 is 9,35,000. Change is 85,000. B minus A. Change is 85,000. Therefore, change percentage is 10%. Therefore, change percentage is 10%. Now, this 10% I will apply to gross amount also and accumulated depreciation also. This 10% I will apply to both. So now you write down journal entry, come back to journal entry format, PPE account debit, 10% of 1 lakh, 10% of 10 lakh, 10% of 10 lakh, 1 lakh. To accumulated depreciation, also, we can take 10% of 1,50,000. Both we will increase proportionately, and therefore, to revaluation reserve, you will write 85,000. To revaluation reserve, 85,000. To revaluation reserve, 85,000. Being asset revalued. Now, my asset after revaluation is 9,35,000 now, and the remaining life is 8.5 years. Remaining life is 8.5 year. Out of 10 year, 1.5 year has gone. So therefore, now my question is, how much depreciation you will provide on 31st March 21? Question, a challenge before the student. How much depreciation you will provide on? Quickly answer. How much depreciation you will provide on 31st March 21? 9,35,000. Remaining life 8.5 year. Time period is 6 months. 1st October to 31st March, 6 months. So kindly reply how much depreciation you will provide on 31st March. Everybody will try. Come on. Everybody will try. How much depreciation you will debit to accumulated depreciation? So the answer will be 55,000. The calculation will be 9,35,000 divided by 8.5 years into half years. 1/2 means half year. How this half year you have calculated? Half year is 110, 22, 31st March 21. That is half year. Chaurasia, Surya, Wagmare, Gogoi, Jain. You are right. So being depreciation charge. Did you like this problem? Tell me, did you like this question? Yes or no? Now note down one homework today. Homework for you, example number 5. Example 5 printed in this revaluation related paragraph, Thakur is right. Example 5. Thakur says, I have liked this question. Now we'll come to next part of this chapter, that is called depreciation. Earlier there was AS-6. AS-6 have been deleted. AS-6 does not exist now. All those paragraph related to depreciation is now shifted to AS-10. Prithvi has liked the question. Very good. So I will dictate more question if you like. Yes or no? So we will come to depreciation. Today we'll just have some basic discussion and then detailed discussion and calculation will be taken tomorrow. So what is depreciation? Depreciation means systematic allocation of depreciable amount. First you underline systematic allocation of depreciable amount. Systematic allocation. There is a small typing error here. It should be depreciable amount. Systematic allocation of depreciable amount of an asset over the useful life. Systematic allocation of a depreciable asset. So this systematic allocation of depreciable amount of an asset over its useful life. Now suppose this is the asset. This is asset, cost is 5 lakh. Life is 10 years. Salvage value or residual value, salvage or residual value is 50,000. Now what is the depreciable amount here? The depreciable amount will be 5 lakh, which is the cost in our example, minus residual value 4 lakh 50,000. I don't have to depreciate 5 lakh. I have to depreciate only 4 lakh 50,000. Whichever method I will follow, whether it is SLM, WDV or any other method, I don't have to depreciate, first remember, 5 lakh. I have to depreciate 4 lakh 50,000. Then I have to see what is the best method to allocate this 4 lakh 50,000 over 10 years. So what the management has to decide, what is the best method to allocate this depreciable amount over 10 years. So suppose I decide to allocate equally, because I believe the use will be equal, I will divide 4,50,000 by 10. This method is called straight line method, equal allocation over useful life. But I can follow other methods also, like WDV, etc. Now you tick mark important point. On this I will take a question tomorrow. Each part of an item of PPE with a cost that is significant in relation to the total cost of the item should be depreciated separately. So you must be thinking why this car is here. Now this car has, suppose, 5 significant parts. Suppose. Now what do you mean by significant part? Significant part means the value of that part is greater than or equal to 10% of total cost. Is greater than or equal to 10% of the total cost, then I will say significant part. Now suppose these are parts of this car, A, B, C, D, E. and their useful lives are also different. Maybe 20 years, 15 years, 10 years, 8 years, and this tire, suppose tire is party 3 years. These are their useful lives. So what the standard says, very interesting. First you will find out the cost of each part. So maybe you are paying 50,000 rupees for part A. Your question will be, how do I know the cost of each part? You will have to take the help of the technician or experts. Suppose these are the parts. These are their useful life. What the standard says, each part will be depreciated separately. Will be depreciated separately. So if an asset has multiple parts, their useful lives are different, and those parts are significant, then in that case, the depreciation will be separately charged for each item of PPE. So for example, here I will take part A 50,000 divided by 20, maybe 2,500. Part B I will take 1,50,000 divided by 15, let us say 10,000. Part C 30,000 divided by 10, 3,000. Part D 80 by 8, 10,000. And part E 60 by 3, 20,000. So my annual depreciation charge will be a total of these numbers, 2,500, 2,500 plus 10,000 plus 3,000 plus 10,000 and plus 20,000. So maybe you'll have to provide 45,500 rupees this year. Oh my God. Then you will say this will make our accounting very complicated. Yes, you are right. But there is no choice, because their useful lives are different and they are significant. You need to depreciate each part separately. That is what the standard says. Okay. So now we will continue tomorrow, same time. Thank you very much. See you tomorrow. Bye bye. Have a good day.